within a few years, we're going to have days where gold is going to be up a couple $100 in a single day. Once you see silver take out, I think right now, probably the next major important hurdle for silver is about 35 to 37. That's sort of an important quarterly close. That's going to be a big milestone. After that, the clear next upside milestone is going to be $50. After that, we're in uncharted waters. And I think we're going to see some big gaps upward from $50. You can see 70, 80 matter of days or weeks after that.
Gold's extraordinary ascent from $2,500 to $3,000 in just 210 days has defied historical precedent and surprised even veteran analysts. Typically, such $500 milestones in the gold market have taken an average of 1,700 days to achieve. According to analyst Peter Krauth, while long-term gold bulls have long predicted a major breakout, the speed and resilience of this current rally have surpassed expectations. Krauth attributes this strength to a convergence of global macroeconomic pressures, including monetary uncertainty and geopolitical instability, and maintains that this rally could begin a broader and more sustained bull market. While gold has taken center stage, silver's more subdued performance has prompted questions. Krauth reassures investors that silver behaves consistently with its historical pattern, lagging gold in the early stages of a bull cycle. The gold-to-silver ratio remains near 90 to 1, well above its long-term average, suggesting significant upside potential as this imbalance eventually corrects. Although industrial concerns such as tariffs and global economic volatility may dampen short-term momentum, Krauth highlights these factors as laying the groundwork for future gains. Notably, past rate-cutting cycles by the Federal Reserve have historically fueled silver rallies exceeding 300% in just 1 to 2 years. Silver's dual role as an industrial and investment metal further complicates its trajectory. With industrial demand now accounting for nearly 60% of total silver usage, driven by sectors such as solar energy and electric vehicles, there's less supply available for investors. Krauth emphasizes that this constrained supply could amplify price surges when investment interest returns. Technically, silver may be on the verge of a historic breakout, with a long-term cup and handle pattern indicating the potential for a rally beyond $50 and possibly as high as $100. Krauth also warns that if the Federal Reserve responds to fiscal strain with aggressive rate cuts, a loss of monetary credibility could drive massive inflows into gold, and subsequently, silver, potentially pushing silver to $40 by the end of 2025 and toward record highs in 2026. We present clips of Krauth's insights from his recent video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
I think that right now, we talked about this just a little while ago, but if I think that, the run-up that we saw in the last few months was pricing in the concerns, and there was a premium in there. So I think the market, bought the rumor and then sold the news when the tariffs came out. We saw that the tariffs clearly did not apply to gold and silver. So that some of that premium has gone away, but not all of it. I'm convinced that it wasn't a huge premium, because you can see now that the metals have not, and gold in particular, has not backed off that much. I think there's some risk of a little bit more downside, especially if you see, I think we're probably due at this point for a bit of a bounce in stocks. I think that, I'm not saying that they're cheap now. I'm just saying that I think that the sell-off was, in fact, it was a bit of a historical sell-off, is what I'm reading, in terms of the degree over the time frame that it took to get that correction in stock prices. Very much near term technically. I think stocks are due for a bounce over the next few weeks probably. And if we get that, I could certainly see, funds flowing towards stocks and away from precious metals. I think we could see a second smallish leg down in the precious metals. And I think that would make for an absolute perfect opportunity. It's interesting, you hear all these sort of theories and ideas about why Trump's doing what he's doing. And one of them that certainly to me makes some sense is that, if he has let's say, proper or true intentions of trying to sort of right a ship, and knows that the U.S. is on an unsustainable debt path and so on. There are huge amounts of I saw that it was something like $9 trillion of U.S. debt coming due this year, and a large amount again next year. I mean, the U.S. debt is about 36 trillion. So we're talking about a quarter of U.S. debt coming due this year. Think about how we are at considerably higher rates than we were, a few years ago. So to have to refinance all that debt at now much higher rates leads to even bigger deficits. So I guess the scenario or the narrative was that Trump was doing this to sort of quote unquote, seriously pressure markets to get the economy to weaken considerably as well, which would force the Fed to eventually cut rates, which would make refinancing U.S. debt a lot more palatable at much lower rates. So that's one narrative, which, if you think about, makes some sense to a fair extent. I just think that this whole thing with precious metals has a long way to still play out. If you ask someone 15 years ago when gold was at, I don't know, let's say $500, $600, $700, they could see a time where it was going to go to 2,000. They thought you were crazy if you said absolutely it's going to 2,000, and today we're at 3,000. We're 50% above that kind of level, and yet people are really just only sort of starting to get interested. We've started to see funds really shift and flow into physically backed precious metals ETFs. Gold can go from 2,000 to 3,000, and funds will flow out of these ETFs. It tells you that the appetite was not for the metals, despite there was no chasing in a sense. Really, there was no chasing these metals prices higher. What investors were doing was they were chasing stocks. And so I think we're starting to see a big rotation start to happen, especially now that we've had this huge correction. I think the smart money was getting into precious metals because it saw the extreme overvaluations in stocks, and the smart money was in early. And I think now you're going to start to see that trickle down from smart money, to sort of more sophisticated investors, and then you're going to get moved towards this sort of regular informed investors and down to the dumb money, so to speak. And that's going to take a while to play out, and then you're going to have a lot of fear of missing out, and that's when you're going to get these huge run-ups. Within a few years, we're going to have days where gold is going to be up a couple $100 in a single day. And we're going to see, once you see silver take out, I think right now, probably the next major important hurdle for silver is about 35 to 37. That's sort of an important quarterly close. That's going to be a big milestone. After that, the clear next upside milestone is going to be $50. After that, we're in uncharted waters. And I think we're going to see some big gaps upward from $50. You can see 70, 80 matter of days or weeks after that. These have forever been safe havens. They're still, in many ways, on many metrics, relatively cheap. And so I think that there's a lot of runway left in both metals. People just need to start to have at least some kind of exposure.
Peter Krauth has expressed significant concern over the recent developments in the precious metals market, particularly regarding the massive order for gold at the COMEX. The reported request, which amounted to $40 billion, set off alarms among traders and analysts, with many speculating about the identity of the buyer and the reasons behind such a large demand for physical delivery. While the COMEX later attributed the spike to an error, Krauth argues that the real issue lies in the delay in securing physical deliveries earlier, which he believes could have prevented the situation from escalating. He points to the movement of metal from London to New York as indicative of a much larger concern surrounding potential tariff impacts, with institutions trying to avoid being caught without sufficient physical assets. Krauth's analysis emphasizes the growing tightness in the physical metal market, as inventories in major hubs like London have plummeted to historic lows. The increasing premiums on silver clearly signal this scarcity, with buyers more eager than ever to secure physical holdings. While precious metals have held their ground relative to more volatile assets like the Dow and S&P 500, Krauth warns that this tightness could lead to heightened market volatility. With shrinking inventories and mounting demand, he believes the precious metals market could experience significant price shifts and that investors must prepare for further uncertainties.
I don't think there was an error. I think that the error was not taking deliveries more gradually earlier. That was the error. Waiting and wanting to try and do this all in one shot. I think that what we've seen happening with these huge flows of gold and silver from London to New York are very indicative of. Some of it. So there's a couple of arguments. One of the big ones is the obvious one that there was concern about tariffs on these metals. So if someone had to deliver into a contract before a certain deadline, with tariffs potentially having been added to these metals, that they didn't want to get caught offside and have to deliver metals that they didn't have on hand and have to pay this, whatever it might have been, say 20 or 25%. That would obviously sink a bunch of institutions. So they tried to front run it, so to speak, get the metal into the U.S. And have it available. What I find interesting is that you're right. There are these contracts with large amounts that are standing for delivery. I just saw a chart where March deliveries of silver had their second highest ever. If you go back, I'm not sure how far back they track, but the chart that I have goes back to 2007, and it's a clear standout that people are taking physical delivery from the COMEX for their silver and their gold. And this is unlike the Shanghai, for example, futures exchange. This is an exchange that was not set up for physical deliveries. I think there's two things happening. One is that it's a question of being able to there's probably three things happening. There's probably, some of these participants that want to have the physical metal to offset some shorts. I think that you've got some industrial consumers that want to get the physical in their hands because they need it for a production of all kinds of things, anything from solar panels and EVs all the way to military applications. And then you've got a lot of these deliveries. What I've heard is that not all of these deliveries are going in and staying in the COMEX. They're actually the metal is flowing to New York, and then it's going into private vaults in the New York area. So there's obviously very little information around that, but these are the kinds of things that I'm hearing. And, if you look at the London inventories, I've got a chart in front of me, and it's at 10-year lows, and it's dropped off. It dropped off dramatically in 2022, and then it's dropped off again dramatically in the first 3 months of this year. So obviously the last few months, that's because most of that will have flowed to New York. But London is the largest, has the largest inventories, or still has, I think, the largest inventories of silver. So it's starting to get really, really tight in terms of physical supply, and the exchange for physical premiums on silver have been through the roof. So that means that market participants really, really want to get their hands on physical silver, and they're willing to pay for it. So that really, again, clearly speaks to tightness in the market. And I think it speaks to a little bit of anxiousness. Participants really want to have their hands on the physical silver, are uncomfortable with with futures. Again, just to kind of summarize it, I think the draining of these secondary inventories, both, where all three, New York, Shanghai, and London, speak to the need for physical to meet demand.
Gold and silver are poised for substantial growth in the coming years, fueled by strong government policies and global market shifts. As governments ramp up investments in green energy and defense, silver, in particular, stands to benefit from increasing demand, especially in solar panel production, where newer technologies require more silver per unit. This rising consumption and global efforts to streamline mining approvals set the stage for a structural increase in silver demand. If gold continues its ascent, reaching $3,500 to $4,000, silver could follow suit, possibly testing or surpassing its all-time high of $50 by 2026. Investors will likely turn to silver, drawn by its affordability compared to gold and the greater number of ounces available per dollar, making it a key asset in the years ahead. Furthermore, the growing push for renewable energy and government-backed initiatives in defense and infrastructure could keep both metals in high demand, enhancing their role as valuable stores of wealth. As geopolitical uncertainties persist, the potential for precious metals to act as a hedge against inflation and economic instability will only increase. All these factors combined suggest a compelling future for both gold and silver. That's it for today. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.